Well, big tech may be on the verge of an even bigger problem. Our next guest warns rising rates will spark a 15% correction if earnings do not dramatically exceed expectations. Class is in session now with the Dean of Valuation, Aswath Damodaran, finance professor at NYU. Professor, great to have you with us.
Glad to be back.
15% correction. From what point do you measure that, and what do you mean by higher rates? I mean, is 1.5% higher, or is it really 2%? Is that higher?
Yeah, I'm not a soothsayer, but there are two things that trouble me about this market. One is if you look at the expectations of earnings, clearly the market's expecting a strong comeback in the economy, even stronger comeback in earnings. And I don't have a problem with that story. At the same time, the market seems to be pretty sanguine about rates until the last few days. I mean, it seems to assume that the Fed can keep rates at whatever they want them to be. And those two stories, in my view, are at war with each other. You can't have both those stories in your head and expect those stories to both coexist. So what's happened over the last 5 days is something I think we're going to see back and forth for the next few weeks, maybe even the next few months, as the two stories fight for attention. When the rate story wins, stocks are going to go down. If the earnings story wins, stocks are going to go up. But overall, I think there has to be some kind of, you've got to resolve that contradiction. And that's where the 15% comes in. If you build in the expected earnings and you build in a rising rate structure, you're going to come up with a level of the index about 15% below where it is right now.
We've already seen this sharper correction or sharper declines in big cap technology, Aswath. And so I'm wondering, in your view, as you have witnessed this, if there are stocks you think were unfairly punished, or if all big cap tech, in your view, is still vulnerable to some sort of pullback should rates go higher.
You had a good run, not just for a year, but for a decade. I mean, we're living off a lot of fat in these stocks. I mean, September of last year, I valued the FANG stocks plus Apple and Microsoft, and only Microsoft looked undervalued to me then. And the other five were not massively overvalued. This is not some kind of a bubble, but they're all 15 to 20% overvalued. I mean, I've seen what you've seen in the last 6 months is, consolidation, sideways movement. I still think Microsoft of those 6 companies would be the one I have in my portfolio. But I think part of the adjustment here is you're giving back gains that came much too easily, in my view.
Professor, it's Tim. Thanks for joining us. If I was in your class, my guess is an entry on the curriculum would be pointing out just the relationship without the interest rate dynamic of valuation to stocks. And with COVID, we got to this place where we didn't care about valuations. There was this mulligan on 20 and 21. But at some point, as we get through 21, even without the factors, I think you could have taught in your class, and I'm sure you do, that earnings do matter. So I know you've brought that up, but I would make an argument with a 110 10-year. At some point, we have to pay the piper on what we did during COVID when we said we don't care about earnings. Is that, am I in line there with that?
I completely agree. I mean, I think, you spend $1 trillion here and $1 trillion there, sooner or later, it starts to add up to real money, as they would say. At some point in time, I mean, we've front-ended a lot of spending that we would have done over 4, 5, 6 years. So I think that, and that's what troubles me about the story. If earnings are coming back because we're feeding money into the system, then how can you stop rates from coming back? The Fed can't stop them if inflation keeps going. Because, the Fed can say whatever it wants. But if inflation hits 2.5%, 3% and keeps rising, there's nothing the Fed can do to keep rates from going up. Absolutely nothing. They can try to tweak it at the margin, but the Fed will be more spectator than rate setter at that point in time.
All right. Professor, it's always great to speak with you. Thank you for your time.
Thank you.
Aswath Damodaran of NYU. Dan Nathan, we didn't get to this, but the professor thinks that Airbnb is one of the more vulnerable stocks to any sort of interest rate sparked correction here. What do you think?
Yeah. Really good point, Mel. It's one of the most vulnerable stocks, but the company is probably set to start to party again, right? So when you think about it, the post-pandemic world, this was a company that was already dominating and disrupting the hospitality industry and moving into other things. So that's where the disconnect has happened. We're talking about the stock. Now, it's also on the tape tonight. They're raising $2 billion in a convert. They're doing exactly what they should be doing, right? And they made some very quick moves at the start of the pandemic, reducing their costs, cutting, staff, that sort of thing. So this is a well-managed company, and this is a company that provides a service that's been massively disrupted to one of the biggest industries in our country. But divorced from the stock and the valuation is a really important point. So yes, it could be vulnerable, but when I see a company doing a $2 billion convert a couple months after they did their, or they came to the public markets, and I'm saying to myself, this is probably a pretty smart management.